Hello, welcome to another edition of Nucleus Investment Insights. Just a quick reminder that everything you hear today is general advice. It's none of this is personal advice, and if you do want any personal advice, you can have a look at our show notes and make a booking to speak to somebody. So today what I wanted to run through was looking at valuations in the stock market. And it's sort of this interesting thing that when you look at stocks, they're absolutely expensive on a weighted basis, which is the way everyone invests. But when you sort of dig into the numbers, they actually don't look anywhere near as expensive when you start sort of segregating into different groups. And I thought that's well worth having a look at, because there's sort of this there's an argument that says, well, what would happen if, say, that the top 10 stocks in the market were actually the best growth stocks in the market? The top 10 by size were the best growth stocks. And so therefore they deserve to be on a higher multiple than the rest of the market. And then the rest of the market sort of sits, so let's just say, for argument's sake, they're sitting on 25 times, and then the rest of the market's all sitting on 15 times sort of future profits. And that sort of 15 times is in line with historics, and the 25 times is in line with what you'd expect for the top stocks in the market, and it just happens to be that they're the top 10 at the moment, which is why the whole market sort of looks expensive. And so I'm not completely sure I buy this whole argument, but I think there's enough nuance and enough interest. There's enough sort of interesting sort of stats behind it that is worth that's worth considering as an option. And so, so let me dig through. This is a little bit slide heavy as well today. So, we'll put some notes for anyone listening afterwards, or listening to the podcast. We'll put them up in the show notes, so you can download the slides and have a look at some of these charts. Because I've got a whole bunch of different things that I wanted to go through in terms of those. Sorry, let me just pull these up now. So, okay, so we've got, yes, so what we've got is, I'm just showing now sort of these overall market ratios for the market. And so part of that is, there's all these different ways you can measure it, but, I tend to try and use forward price to earnings ratios. I think is the most useful, and I think stripping out banks and resources or financials and resources is a much better way to look at it. There's a bit of a long story behind that, but largely it's those sectors have just got some differences in them in terms of the way the earnings are measured and leverage and volatility behind it, that it actually makes a lot more sense when you strip them out and then look at those sectors separately. So on that basis, we're back to the highs we hit post-pandemic, where there was all this massive growth sort of factored in that as the stocks came out of the pandemic, there'd be this massive amount of growth, and so we're sort of looking at 22 times, say, on that global financials ex resources numbers, and just to highlight the way these are calculated is that if Nvidia is 10% of the index, then it gets a 10% weight in the overall. You sort of basically, it's a little bit more complicated than this in terms of making the maths work properly, but largely you're sort of saying, okay, it's 10% times Nvidia's PE and 7% times Microsoft's PE, and you work your way down to once you're talking about all the small stocks, it's fractions of a percent of all these small stocks. And so the biggest stocks have an outsized impact on what happens. So another way you can look at these, though, is say, let's just take these same numbers and let's stratify it. So what we're going to do is I'm going to create 5 buckets based on the size, and in each of those buckets, we're then going to do that same calculation, but only include the stocks. So what we've got is it's called quintiles when we do the by fives, and so the top quintile with the yellow line on this chart is showing the stocks that are the largest 20% of stocks, and just for reference, I'm using the top 1,500 stocks globally, which is sort of equivalent in Australia to the top 60 to 80 stocks in Australia. Okay, so it's just the biggest stocks, and also this number of 1,500 stocks that makes up like over 80% of global markets by size. So, okay, so when we look at it on this basis, yeah, we can clearly see that yellow line is up there. It's it's back to the same peaks as what it was in 2020. It's not as high as what it got during the tech boom, but it's certainly miles above where it was, for most of the 2000s. And also that we can see that actually for most of the 2000s, the large caps was the lowest number on that. So as you look anywhere from 2008 through to 2016, for example, this yellow line, which is the biggest stocks, actually had the lowest valuation of any of these groups. And the light blue line is the smallest stocks. And so when you sort of look at it on this basis, you go, well, okay, so we've got the largest stocks there. They're clearly more expensive than what they've been in the past. The next group of stocks, the next largest ones, they're expensive. They're more expensive than sort of the lower groups, but they're more in line, with where they've traded over the last sort of 20, 25 years. So it's not like they're clearly towards the upper end of it, but it's not like they're miles above in the same way the first group is. And then you get into these, the black line is the median stocks. So the middle sort of 20% of stocks. Arguably, they're cheap. They're cheaper than what they were through most of the 2010s and even earlier 2000s. They're cheaper than those levels. So they're sort of trading at sort of 15 times, and plenty of times they've been. They spent most of the time closer to 17 times through the 2010 to 2020, and similarly in further back, and then pretty much the same story for those bottom two categories as well. They're just not that expensive on that basis, and so okay, so that's one factor. The next factor is saying, why might that be? So are we looking at what's different in these larger stocks to how that is in the past, and is it just that these stocks are the best? They've got the best growth profile, and so maybe they've just because they've got the best growth profile, maybe they deserve to be sort of towards the top of this. And that's where I get to this next chart, and what I'm showing here is a similar type. It's the same chart at the top, just for reference, just so we can see where everything sort of sits. But what I've got below that is what I'm calling. So I'm looking at the proportion of that top 20% that's made up by different sectors, and I've split it into three categories. I've said, well, what are the low PE sectors? Our financials and resources, the sort of medium PEs, the manufacturing stocks and the defensives. And then what I call the high PE sectors, which is your technology stocks, consumer stocks, and services. And so they're the ones that typically trade on higher price to earnings ratios because often because they just don't have the same capital expenditure. There's a whole bunch of reasons behind that in terms of volatility of earnings and risk and stuff like that. But so when you look at that, you can pretty clearly see from this chart that really correlates to what we've seen. So we had this sort of in most of that sort of 2006 to 2016, financials and resources actually made up a pretty big chunk of the index, and so because it made such a big chunk of the index, because they're the low PE sector, not big chunk of the index, big chunk of the top 20 by size, and so because it's sort of like, okay, if a bank happens to be, or if you get lots of banks that happen to be the biggest stocks in the market, then naturally the market will have a bit of a lower PE because those things trade on a lower PE. Whereas if you've got lots of tech stocks that make up this top 20%, the biggest stocks happen to be tech stocks, then you get the reverse happen. And so that sort of sits and going, well, okay, so a lot of this you can just explain, at least from this perspective, you can go, well, you can explain a lot of the excess in terms of PE, just in terms of the fact that the biggest stocks happen to be part of these high PE sectors. Okay, so that sounds, that sort of gives you some, I guess, at least a little bit of comfort in terms of saying, okay, maybe there is a reason for these larger stocks to be priced where they are. Then you say, then you go back and you go, okay, well, what would happen if we then said, let's just have a look at the growth. Now, the growth is difficult for these. There's a whole bunch of different ways you could look at it. I've picked. I had a look at a range of different measures in terms of coming up with something to really get a better feel for which is the right growth number, and it's messy to say the least. So one of the issues you have is that you can talk about historical growth and what's the historical growth been to this point, and you get some things that look pretty good in terms of that. In terms of saying, okay, a lot of the stocks that are that look more expensive have had this great growth over the last few years, and you go, well, yeah, okay, that's one thing, but it's nice to know that it has had great growth, but you're only going to pay up for a stock that's going to keep growing. Like, it's no sense in we're not paying for stocks. We're not paying for past performance. We want to pay up in terms of valuation for stocks where we think the next year's performance is going to be good. And that's where this next chart. Oh, sorry. And so then you say, okay, well, let's try and sort of shift forward into that. And ideally, what I'm trying to do is say, I think the best measure, not to say it's this is a very nuanced issue, but the best measure I've used, I think, is saying, let's look at the 12-month forward PE. So what are they expected to earn in 12 months forward time, and versus the earnings growth, and then versus the share price, and then let's have a look at the earnings growth beyond that period. So it's actually the growth rate from the 12 months out to 24 months out that we're looking at to say, well, is this growth factored in? Now, there's I'll actually bring that chart up. There's nuance in this as well, insofar as analyst forecasts that far out tend to be pretty mean reverting. Like, they tend to be, these companies are going to grow at 10%, and then they'll push you away from there. But anyways, but on this basis, I think if you squint and look sideways, you can come up with an argument that these things have got a higher growth than some of the other sectors. So the top line is the price to earnings ratio. The bottom line on this one is the 12-month forward earnings growth. The earnings growth from 12 months to 24 months of the companies in that little basket. And it's certainly not conclusive. I think when I look at this on a historical basis, it looks a lot more conclusive. But when you look at it on this basis, it's like, well, they're the highest, but by fractions of a percent versus the other sectors. Actually, the smallest groups actually have pretty reasonable growth within this as well. And so, there's really not a lot, not a lot of support to that argument that these stocks have got the highest growth forecast. Now, I do think you need to caveat that by saying analyst forecasts, in the distance, don't tend to be, they tend to cluster, and they tend to come back to this 10% growth. And so the further out you go, the more likely they're going to come back to that 10% or even sub 10% growth. And it's just I guess it's a nature of saying, particularly in the US where a lot of these stocks are based, is that there's a big focus on the quarterly earnings, and it's like, well, I'm forecasting NVIDIA is going to increase to 30%, 40%. It's profit for the next quarter, and then it's going to go back to 20% the quarter after that, and 15% the quarter after that, and sort of tail off to, by the time you're 24 months out, you're back to sort of 12% growth. And so that's where I think the potentially there's people looking at these stocks saying, well, that's what the numbers the analysts have, but I'm actually expecting this boom is going to be bigger and better than what's in the numbers. Okay, so that's one part. The other part then is saying, well, okay, let's have a look then at the individual sectors, and let's say, well, what if we break those same sectors up and said, okay, well, let's just take those technology consumer services sectors. Are they trading higher than what they have in the past? And the answer is absolutely yes. When you come back to those on a size weighted basis, the answer is yes. You can do it on a median basis as well. So just look at forget size and try and work it out. It's not as conclusive, but it certainly does look like they're expensive. That's the bottom chart on this one. The top chart is then saying, okay, well, what happens if we did break it up into those individual? Like, don't worry so much about the grouping it into these high PE sectors. Let's actually just break out the individual. Now, on this basis, technology is sort of trading, 27.5 times in terms of the earnings. So which relative to where it's been in the history is is right at the top end of where it's been the last 20 odd years. And you go back to the tech boom, and yeah, it was high on the tech boom, but it was obviously that was a bubble. If we then sort of start looking through some of those other sectors within that, you sort of go, well, the consumer sector, expensive, but not, it's certainly traded above that multiple times in the past. So on the upper end is, the top. So it's in its top quartile, but it's not right up the top. And then as you start going through the rest of the sectors, though, they all sit largely in line with where they've traded for the last sort of 20, 30 years. Like none of the other sectors really stand out as being particularly expensive relative to their history. And a number of them you'd say are probably cheap relative to their longer term history. Anyway, let me just jump to a quick message and I'll come back to see.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So we're sort of sitting there at the stage then where we're saying, okay, so we can clearly see large stocks are more expensive than been in the past, and even more specifically, it's large tech stocks. The consumer sector is slightly expensive, but most of the other sectors are largely about right, or largely, I guess, in line with where they've traded in the past. And so that sort of starts to, you start to think, okay, well, what does that mean in terms of where we're going forward? Does that mean actually if we just took you just sort of weighted yourself down into the into all these other sectors, what you're effectively saying there is, okay, I'm buying these sectors at an average price. If I just ignore that tech sector and say, let me just focus on these, and so there's some, there's potentially an argument some are making around that, saying, yeah, this is where you're going to hide. It's just in these other sectors and potentially other countries. The issue though is particularly in the US at the moment is, well, are those sectors in for a much bigger downturn though? And so what you're looking at is you're saying, well, how much is, when I'm buying this tech sector, is the fact that, well, that's the only sector I'm going to get some growth from. I'm looking at downturns in consumers, downturns in manufacturing, all these other factors that are sort of quite negative on it. So maybe I should be paying under the market multiple for these other sectors. And the question is, how much am I willing to pay up for this tech sector? And particularly, given this is a capex boom sort of driven story, as we spoke about a lot last week, is that if it is capex driven and what we're looking at is the rest of the economy is sort of going to be weak, that sort of actually opens up a bit more room for that capex to drive. And maybe if interest rates are a bit lower, it actually means a bigger capex cycle within the AI side, because lower interest rates mean that you can afford to spend more, and the fact that other sectors are weak means you're not competing with other sectors for resources, and so maybe that just means an even bigger boom within that. So yes, lots of issues in terms of that. What are some of the other ones? The stocks, all the charts have been showing is global. So things do look worse when you look at the US, but actually largely, the US is sort of 70% of this global market anyway in terms of size. So, the conclusions aren't that different when you do it that way. And then when you start jumping in, let me bring up some charts just to show you the price to earnings for, say, Europe. And I've done these on a relative basis. So this is just saying, where does Europe sit versus the rest of the world, or where does Japan sit versus the rest of the world? And look, they look very cheap on that basis. It's just they're sort of trading at 30-year lows in terms of, or 25-year lows, on this basis in terms of where you're sitting in terms of relative valuations and what you're paying for stocks from Europe or Japan versus what you're paying for in the US. But most of that story is either sectorial or size based as well. In that it's the same. Yeah, but it's basically this same argument we're looking at from all those other stocks is that, do I try and hide in these other sectors or these other countries where the valuations are much more reasonable, are much more similar to their long term averages, but the growth rates are really at risk. Okay, so that's roughly that. I'll jump to another sales message and then want to come back and talk about investment implications and what that really means.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, from a investment perspective, what I want to focus on is there's sort of 6 big contradictions I think you see within markets at the moment that we're really trying to focus investors in on, and I guess sort of which is changing our thinking in terms of what we're doing. So the first one is that, look, company earnings can be dramatically different to GDP growth. And there's actually, we spoke about this maybe a month or two ago. There's a lot of the long-term evidence, sort of particularly between countries, sort of suggests a negative correlation between some of these. And I think at the moment for us, we're seeing some of the biggest divergences we've seen in a long, long time between the earnings, which is still pretty strong in terms of overall earnings growth, versus GDP growth, which just seems to be weakening, particularly US side. So earnings look far better than what the US economy does. There's let's just call politics fraught at the moment. I think there's certainly lots of issues. There's the US in particular is on a trajectory to certainly whether you want to call it dictatorial or certainly if you want to be nice about it, maybe it's just saying that the president will have far more power than what they have in the past and far less restrictions on what they can do. Now, there might be problems for that socially and all these other factors go, but it doesn't necessarily mean a weaker short-term economy or even medium-term economy or weaker stock market. Like that's that same part, the contradiction between these fraud economics and economic performance. Now, overlaying that one more time as well, though, is the existing government shutdowns and civil strife and things like that. Now, that can cause much more bigger economic problems. But I guess where I'm getting to is, on their own, countries that are progressing maybe or regressing into a much more dictatorial and less democratic nations, the earnings growth you get from companies doesn't necessarily correlate with what you might be concerned about from a political perspective. That's our second contradiction sort of going on there. The next one is regulations being removed now, and lots of them. Like it's been a pretty wholesale slashing of regulations. Now, are there going to be future risks out of this? Are you risking, say, future bubbles and all that type of stuff, and crashes and things like that? Absolutely, you're risking them. But company earnings is almost certainly going to be higher as these regulations go. That's the reason for removing a lot of these regulations. And even some of the ones you might be concerned about, say, in terms of saying, look, there's you get rid of consumer protections and there might be a crash at some time in the future. It's like, but there has to be a bit of a bubble first before you can get the crash. And so, so there's not that, you might be going too early if that's your concern for it. So we've got that regulatory one as the third one. There's lots of stuff going on around tariffs and inflation, lots of contradictions within that. So we've got these tariffs, they're pushing up inflation. You've got reduced immigration and quite sharply reduced immigration, sort of putting some wage pressure on. But at the same time, you've got quite a weak economy there. And so it's this weird part where you got some short-term negatives. The midterm is concerned about the midterm has some sort of concerns about heading to recessions, or are you betting higher inflation? Is it stagflation? Lots of different things like that. Long term, the really long term yields are rising. So certainly some contradictions within economics about what's the more powerful force. Is it the inflation and the tariffs and the reduced workforce, or is it the economic weakness that's that's going to come out for that? Then you have this number 5 is this idea that, look, we're probably headed for longer term, higher inflation in the longer term based on government spending. So governments around the world have basically sort of embraced this, look, we're going to run bigger deficits than what we have in the past, and it doesn't really matter whether that we're not, that you're not sort of spending this to bring you out of recession or anything like that. It's just about, the money needs to be spent for defense purposes or whatever it is, or just because we want the economy, we don't want a weak economy, so we're willing to go into debt to try and to do it. And that's a big transfer. Tends to be, well, effectively, it's a transfer from the government to either the consumers or household sector or the business sector, and you just got to assess, country by country as to which is more likely. And most of the time, if you're ever in doubt, the business is usually much better at when governments are spending money at grabbing a bigger share of the economy from it. And that means company profits can be a big beneficiary from that. And typically, particularly if we are headed for a higher or longer term inflation, is that companies and company earnings are one of the better places to hide from that. They are the ones that will probably benefit from higher inflation more than others. So that's our 5th one, and then the last one is what we sort of focused on today, is this idea that, look, we've got these extended valuations, but it's quite specific. It does happen to be in the biggest companies, but those biggest companies are also tech companies. So within one particular sector, that sector is traditionally traded on higher multiples. The question is now, are the multiples you're paying for this worth paying in order to get this growth? And if you try and hide in some of those smaller sectors, hide in some of the smaller or the other sectors that look trading a lot more similar to where they've traded in the past, are you actually just running the risk that you're going to get the sectors that are going to be most hit by the growth and most hit by sort of economic downturns? And so, you get to a lower valuation, but the earnings stay low. And so, it's this idea about saying, if I can buy something 10% cheaper than it usually trades at, but its earnings are 10% worse over a 2-year period, then I'm effectively back to a market valuation for that thing. Whereas if I'm buying a stock that might be 10% more expensive than what it's traded in the past, but it's going to grow 20% faster over 2 or 3 years, then actually I'm going to be in front. I'm going to be on a better valuation, after that time period. And I think that's the assessment that that we're trying to sort of add up and work as in terms of what we're putting into our portfolios. So, really key focus for us is this idea about letting earnings and earnings revisions sort of guide your exposure. I think there's some GDP things you can look at, and they're certainly interesting in terms of where interest rates are going and all the different factors behind that. But the disconnect is really large, and I think trying to run your equities exposure based on what you think is going on in the macroeconomic economy, I would be cautioning against. And I do think there's a whole bunch of these landmines out there, macroeconomic landmines that the economies need to avoid. But if they can avoid them, and we can even see that relatively weak economies, but reasonable growth within equities. And then, as we spoke about last week, this data center rollout is really the key to trying to work out whether how long this boom can go on for, because there's numbers out there sort of showing that if you removed the extra capex spend on tech and tech equipment in the US, you basically got a GDP pretty close to running at zero. Now, so effectively saying the only growth you're getting is from this is from the tech sector. And so if that's the case, that should be our key focus in terms of investors going, well, it's our biggest sector, the biggest exposure, the most expensive sector. How long can that growth keep going for? What are we watching to try and keep track of it? And in my view, there's sort of 2 elements to this. How does it end? It either ends in a bang or a whimper. If it ends in a whimper, well, what should we be watching? Well, we should be watching that the early stage companies within these, and do we start seeing some of those early stage companies, the people who are breaking the ground and doing the initial work on setting up these data centers, when their orders start to slow up, okay, that'll tell us that the cycle's starting to slow down and where that goes. That's your sort of ending in a whimper. Ending in a bang is those companies aren't going to be of any use to you. What's going to happen is companies sort of, you're going to see company valuation go up and lots more crazy amounts of money raised at crazy multiples to fund loss-making companies who are then going to plow the money back into the rest of the sector. And then at some stage that'll dry up in terms of the funding, and just the next listings won't happen, and then all of a sudden you'll go into this sort of vast unwind. And so we're sort of trying to track both those measures as best as we can, and really keeping an eye on company earnings as to guide as to when you need to be taking, I guess, a lot more caution. That's it for today. Thanks everyone for tuning in. Just a reminder, we are on all the major and minor podcast platforms. You can get more of our stuff, nucleuswealth.com/content. If you jump onto our different social media, you'll get updated on when we're starting and finishing these. And look forward to seeing everyone next week, Thursdays, 12:30.